If you're trying to start a business or to buy one, but you don't have money in the bank, this might be the most important video to watch this year. There's a financing tool that serious entrepreneurs and investors use every day, and most people don't fully understand how it works. It's called the SBA financing, and if you understand it, you can leverage your way into business ownership much faster than you think. Welcome back to Inside the Industry, and for today's video, I'm breaking down SBA financing from a broker's perspective, what it is, how it works, and how you can use it and what you need to watch out for. I'm Jake Tobin, a licensed business broker at Transworld Business Advisors, and I work directly with business owners in navigating exits, growth decisions, succession planning, and acquisitions. First off, the Small Business Administration does not directly lend you money. That's one of the biggest misconceptions. Instead, it's a government agency that guarantees a portion of a loan made by the bank. That guarantee reduces the bank's risk, which is why they're willing to lend to small business owners in the first place. So the way it works is simple. You go to the bank issues the loan, and the SBA backs a large percentage of it. The most common loan you'll hear about is the 7A loan, and it's widely used for buying businesses, funding operations, or in some cases, even purchasing real estate tied to the business. Now, this is extremely important to understand that while there are government regulations for SBA financing, banks have their own standards on who they will loan money to. And the process each bank uses can be slightly different. Now, here's why this matters. And a lot of people think that they need to save hundreds of thousands or even millions before they can become a business owner. That's just not the case. With SBA financing, you can often get into a deal with as little as 10 to 20% down. So instead of needing $1 million to buy a business, you might only need a fraction of that. That's where leverage comes in. Smart entrepreneurs don't just rely on their own capital. They use structured financing to scale faster. And that's why SBA loans are so common in business acquisitions, franchising, and industries like construction, landscaping, and HVAC, where there's strong, predictable cash flow. Let's walk through what this actually looks like in a real deal. Say you're buying a business for $1 million. A typical structure might include a 10% down payment from you, another portion financed by the seller financing, and the remaining majority covered by an SBA-backed loan. The key here is that the business itself needs to generate enough income to support the debt. Banks are going to look closely at the company's financials to determine whether it can comfortably make these loan payments. That's why the SBA loans are much more commonly used for buying existing businesses rather than starting brand new ones. With an existing business, you have tax returns, profit and loss statements, and a proven track record of cash flow. But also keep in mind, not only will the business have to show clear financials, the process to obtain SBA financing can take 60 to 90 days, all depending on the size of the business and the loan amount. Can you use an SBA financing to start a business? Well, yes, but it's definitely much more challenging. Without a track record, the bank is taking on more risk, so they're going to look much more closely at you as the borrower. They want to see strong personal financials, relevant industry experiences, and a well thought out business plan. In many cases, startup SBA loans are more common with franchises or operators who have already had industry experience or within that specific field. If you're brand new with no background in the industry, it's going to be an uphill battle. This brings us to the part that most people overlook, the limitations. SBA loans are powerful, but they come with real responsibility. In most cases, you'll need to sign a personal guarantee, which means you're personally on the hook if the business does not perform. Depending on the deal, the bank may also require collateral, especially if there's additional risk involved. You'll need a solid credit score, typically in the high 600s or above, clean financial history, and on top of that, not every type of business qualifies. Some industries are more passive investment models and can fall outside the SBA guidelines. And one of the biggest things people underestimate is the timeline. SBA deals take time. You're usually looking at a process that can stretch anywhere from a couple of months to even longer, depending on the complexity of the deal and how quickly documentation is provided. This is a full underwriting process, not quick money. At the end of the day, SBA financing is an incredible tool, but it's best suited for the right type of person. It works really well for first-time buyers who want to acquire a cash-flowing business, as well as entrepreneurs looking to scale through acquisition. But if you're looking for something fast or you're not comfortable with the personal liability, it may not be the right fit. If you're serious about owning a business, whether you're starting from scratch or buying something established, you need to understand how the SBA financing works. It can open doors that most people don't even realize are available. If you want help analyzing a deal, figuring out if it qualifies for SBA, or finding opportunities that fit within this model, feel free and reach out. If you got value from this video, be sure to like, subscribe, and I'll see you in the next one. This is Inside the Industry, where we make deals simple.